Hey, welcome to The Explainer. Today, we're going to decode the one language that powers every single business on the planet, accounting. I promise, by the end of this, you're going to be able to speak it. You know that feeling, right? Staring at a financial report, and it's like it's in a totally different language. All that jargon, debits, credits, assets, liabilities, it just feels so intimidating. But what if I told you it's not actually complex math? It's a language with a grammar that's surprisingly simple. And the person who gave us the translator for this language wasn't some Wall Street whiz kid. He was a 15th century Italian monk, and his elegant, beautiful system is the key that unlocks this whole thing. Okay, so here's our game plan. We'll start with the monk who cracked the code. Then we'll learn the one simple equation that rules everything. After that, we'll break it down into 5 core words. Bust the biggest myth in all of accounting, and then put it all together in a real-world example before we see how it all still applies today. So let's jump right into Section 1, the language of business, and meet the monk who figured it all out. So this guy, Luca Pacioli, he was part of this amazing tradition of monks who were tackling huge scientific problems. He saw how chaotic merchant bookkeeping was, and he came up with this brilliant solution, the double entry system. Now, think about this for a second. The system he designed over 500 years ago is still how basically every business on Earth tracks its money today. Incredible. Which brings us to Section 2 and the absolute centerpiece of his entire system, the golden equation. You can really think of this as the Rosetta Stone for business. And here it is. Assets equals liabilities plus owner's equity. That's it. This is the one unbreakable law of accounting. All it really means is that everything a company owns, its assets, has a claim against it, either by people it owes money to, those are liabilities, or by the owners themselves, which is the owner's equity. Now, I know that equation might still feel a little up in the air. So for Section 3, we're going to deconstruct it into the 5 core words you really need to know to become fluent. These 5 accounts come straight out of our equation. You've got assets, that's stuff you own, like cash. Liabilities, that's what you owe, like a bank loan. And owner's equity, that's the owner's slice of the pie. The last 2, revenue from your sales, and expenses, your costs, well, they directly affect that owner's slice. More revenue makes the owner's equity grow, and more expenses make it shrink. Here's a great way to think about it. Fruit is a general category, right? But you probably want to know if you have apples or bananas. Asset works exactly the same way. It's the main category, but businesses create these specific little sub-accounts, like equipment or cash, so they can track exactly what kind of assets they have, not just some big, vague number. All right, let's move on to Section 4 and tackle the single biggest, most confusing part of all of accounting. It is time to bust the myth of debits and credits. Honestly, the best advice on this comes directly from our source material. And it's this. I implore you to please forget everything you know about debits and credits outside of accounting. Seriously, forget your debit card, forget about store credits. We need a totally clean slate here. We're all conditioned to think debit is bad, or a decrease, and credit is good, or an increase. In the world of accounting, that is completely, totally wrong. So here it is, the simple truth, the big secret. Debit just means left side, and credit just means right side. That's it. That's the entire secret. So how do accountants organize these left and right entries? They use a super simple little tool called a T-account. And yeah, it's literally just a T shape on a page. It creates 2 columns, a left column for the debits and a right column for the credits. It's just a visual map for sorting the info. Okay, so if debit is left and credit is right, how do we know how to increase an account? Well, the rule comes from a slightly rearranged version of our equation. Remember how expenses decrease owner's equity? Well, to get rid of that pesky subtraction, we can just move expenses over to the left side of the equation. That gives us assets plus expenses equals liabilities plus revenue. And now the rule is just beautiful. Accounts on the left side of that equation increase with a left side entry, a debit. And accounts on the right side increase with a right side entry, a credit. That's the whole game. All right, let's head to Section 5 and see how this all clicks into place. It's time to put these rules into practice and speak our very first sentence in the language of accounting. So let's imagine you run a marketing company. We're going to trace 3 really simple, everyday transactions. First, you invoice a client, then you get a bill from a freelancer you hired, and finally, the client pays you. First up, you invoice a client for 5,000 Rand. Okay, so your revenue just went up. And since revenue is a right-side account, you credit it to increase it. At the exact same time, the money you're now owed, which we call accounts receivable, that also goes up. That's an asset, a left-side account, so you debit it to increase it. 1 debit, 1 credit. Perfectly balanced. Next, you get a 1,000 Rand bill from your contractor. This makes your expenses go up. Since expenses is a left-side account, it increases with a debit. You also now owe more money, what's called accounts payable. That's a liability, a right-side account, so you increase it with a credit. See the pattern? 1 debit, 1 credit. The system always stays in balance. And finally, pay day. The client pays you the $5,000. Your cash, which is an asset, goes up. Assets are left-side accounts, so we debit it to make it bigger. So what's the balancing credit? Well, the client doesn't owe you that money anymore, right? So your accounts receivable, which is also an asset, needs to go down. And to decrease a left-side account, you just do the opposite of a debit. You credit it. And that brings us to our final section, from monk to modernity. Because what we've been talking about isn't just some historical artifact. It's the living, breathing language of business today. You know, Pacioli's system was perfect for a merchant trying to track a single ship's voyage. But that exact same core logic, that double-entry, always-in-balance system, has been scaled up into these massive global standards like IFRS and in the US GAAP. These are the rule books that now govern trillions of dollars in global commerce. And the whole purpose has evolved too. For those early merchants, it was really just about keeping good records of the past. Today, the goal isn't just to see what happened. It's to use that data to analyze how you're doing, to make smarter decisions, and to really shape the future of your business. So this system that was created by a monk almost 500 years ago is now a universal language. And it's not about being a math genius. It's about understanding the story that the numbers are telling. Now that you know the grammar, now that you can speak the language, the only question left is, what story will your numbers tell?